On to Kenya now. Commercial banks have cut interest rates on loans for individuals and households for the first time in around 7 years. Now remember, this is all coming as borrowers are struggling with loan repayments in a very high interest rate environment. This emerged during a period where thousands of workers breached the legal requirement that demands that they take home at least a third of their salary. Data from the Kenyan Central Bank indicates that the value of personal and household loans contracted by around $1 billion to a three-year low of $7.29 billion in 2024. Default rates in personal and household loans hit $780.2 million in 2024, marking an 8.5% rise from the previous corresponding period. In the meantime, the number of loan accounts under households, that also contracted a fair bit, down by 1.4 million to 10.7 million accounts. Let's bring in Nderi. He's a Kenyan economist covering companies and macro trends in East Africa's largest economy. He's an associate at Public Markets Synthesis Capital. Nderi, good to have you in the program tonight. So, given the fact that we're coming off the back of half-year results, one of the main things that we've seen, especially bank results in the first 6 months of the year, is a contraction in the general Kenyan loan portfolio. I&M, for example, its loan book was down 2.6%. NCBA, the Kenyan loan book, down by around 6.4%. Equity's loan book down by 2%. Is this just a case of banks lending less because they're being more picky about credit quality? Or is it a response to the fact that credit demand in the open market, at least at those prices, has dropped?
It's not so much that credit has dropped, because if you observations, especially in the microfinance industry, is robust growth over there. And we're talking about interest rates of maybe north of 4% per month. In the MFI space. So the big problem banks have is number one, they already have quite a bit of risk captured in their books, and their risk appetite has really shrunk. Number two, one of the reasons why their risk appetite has also shrunk is because central bank is leaning on banks to lower their lending rates. And this is having an effect of why banks don't feel adequately compensated for the rates that they're being asked to lend at. So the way to go therefore is to cut personal loans, and this is creating a boon for especially non-deposit taking microfinances.
What's the material difference here that we're seeing with this new credit pricing framework that took effect yesterday on the 1st of September between the one that is in place now and a comparable attempt? I think you and I are old enough to remember this, KBRR, because at face value, it's sort of in theory the same thing, isn't it?
It is actually, and please note that the base rate is not the cost of funding of the bank. The base rate feels like a policy rate, and then now cost of funding is loaded onto that. They want to assume that. I mean, they want to. I think the idea is to try to make it a little bit more dynamic than the earlier one, but really, it's same script, different cast. In as much as it's a little bit more dynamic. To take into consideration market conditions, it really is a one-size-fits-all sort of scheme to try to force interest rates down, and if a lender doesn't feel adequately compensated for the risk they're taking on, and they try to say that it's responsive to risk. When I don't believe it is, because the risk models are being shoved down the throats of the banks. The banks are not at liberty to use the risk models that they feel are appropriate.
From the consumer's point of view, because the counter argument, okay, not a counter argument, but sort of complementary to what you're saying, because if you look at the equation that the central bank put out, right, they'll say, well, there's a cost of funding, which essentially they're using the interbank, the average interbank rate. Over a certain period of time as a proxy for that, and then they load in the risk premium for an individual client. But in the past, we've never really actually seen when the bank says your risk is X, therefore we're pricing your premium at however many basis points relative to other clients or of a similar profile. That sort of disclosure rarely ever happens, doesn't it? So in that sort of environment, I mean, banks would essentially have an excuse here to say, well, your risk premium is X, therefore we're pricing your loan at 19% or 20%.
Yeah, but the ultimate rate, from what I hear whispers in the banking sector, is that you're being asked to lend at rates not higher than X. So whatever your risk premium is, whatever your cost of fund premiums are, and any other premium is, ultimately you're being told not to lend at a rate above a certain amount.
Do we know what that cap by another name is? Do we have a specific number that's being floated around?
No, but I know the CBK is pushing for rates to go below 20.
Is this, from looking at this from an analyst perspective, is this new credit pricing framework likely to depress banks' interest income in Q4 going into 2026? Because if they're still lending, let's take that number at face value, if they're still lending at an average of around 18, 19, 20% on Kenya shilling debt, at face value it doesn't look like it's really going to change much for these banks.
So one thing that's helped is because of T-bill rates that have fallen, so cost of funding for banks has fallen. But so if you maintain rates where they are, banks will enjoy higher margins, of course, but there's a reason for that. They have quite a bit of issues in their loan portfolios. I think the last time I checked, bad loans, NPLs were above 17% and rising. So what that does is that it diminishes their risk appetite. So for them to lend an additional shilling, the interest rate must be attractive enough for them to do so. Otherwise, it makes more sense to lend to government, which has a healthy appetite, by the way.
Indeed, and they've demonstrated that quite effectively with all the liquidity they were seeing being snapped up in the open market. We'll have to leave it there for the time being, though. Nderi, Kenyan economist, there with Public Market Synthesis Capital, joining us there from Nairobi.